I will start with a few opening comments as the policymaker here on 25 years of looking at the issue we're dealing with, progressivity in our tax system, and just make a few points. Number one, I am in the category who thinks our tax code should be way, way more progressive. It is worth noting that it is not like there's ever been positive movement. For example, the Clinton came in at 31%. It went to 39.6% with Medicaid, Medicare counting up. It was almost 43%. So we have seen moments of like a 40% tax increase in the top couple of percent. We saw a return to that kind of level under President Obama, even higher. Secondly, as we've seen, there's been dramatic increases, however you classify it, in the earned income tax credit that's had very large impacts. We've also seen a lot of negative things happen in terms of progressivity, 21% corporate tax rate that nobody that I know was really asking for, the reduction in capital gains dividend. So this is one thing. Secondly, one thing I think we've seen recently is more of a focus on the top 1/10 of 1%. There's been much more focus on the top couple of percent. Now you're seeing much more of a focus from AOC on 10 million to Senator Warren on wealth over $50 million. So we're seeing much more of a focus at the very, very top. Next, I think these things are relevant on the revenue estimates when you're a policymaker. The top 1/10% actually raises more money than when we looked at those proposals in 93. So as the revenue goes higher, so does the political attractiveness or worth fighting for actually going at that target. One of the reasons capital gains becomes difficult is the Joint Tax Committee and the Treasury models don't tend to give you additional revenue after a certain amount, something I personally highly question and would love to see people and would love to see people take on. The next thing I think is the wealth tax. I join Gabriel on this panel on being a supporter, and actually a very strong supporter. I think that just a few points. Number one, it goes some of the things Stefanie talks about in terms of clarity. Much of the reason why sometimes progressive taxes are less popular is because those who oppose them diffuse and make people think it hits everyone. When you have something like the Warren tax, it hits only people 50 million and above. It is very clear, it is communicated well, and the public can therefore make a choice on what the proposal is, not how it is phased up. Secondly, it's analogous to people in their annual property tax. Because they have that every year. That's their main source of wealth. And so the idea that you would look annually at the main source of wealth for people in the top 1/10 of 1% is easy to understand. I am somebody who supports this mostly for what it can do. I look today and I see the benefits of increasing quality, free higher education, of quality, free, lower, pre-K, et cetera. And I am reminded that under any of the estimates, but certainly the estimates that David Kamen and Batchelor came up with as a neutral, I would say, between Gabriel and the Summers debate. But even by that, you could fund all of those things. Looking at our discussion today, how is that not only right morally, but pro-growth? Finally, I'd just say that I cannot buy into the defeatist view on the enforcement side. Gabriel and I do use a similar quote I've noticed, which is that enforcement is not a law of nature, it's a policy choice. The difference in the amount of money collected, if you believe 15 versus 50%, is about $800 billion over 10 years. There's quite an incentive to spend, I don't know, 10 million more a year if $800 billion is at stake. And there is a difference between something having negative unintended consequences and therefore being a bad idea and something being a complex idea. Many things are complex. We work through complexity all the time. So we do have to distinguish between, is something going to actually have a negative unintended consequence, in which case it's a bad policy, or whether it's just highly complex, which just means that it may not be perfectly administered, but doesn't make an argument whether it is worth going forward. And the last thing I will say, as I'm already being slightly over. But I think I just want to point out that those of us who care about this should be looking at the tax side on the wealth inequality from the bottom as well. This is something I have cared about. We did the USA account in the Clinton administration. Our tax code is upside down. Those of us who give $1 to our pensions today will get about a 40% deduction if you're in the top 1%, and if you're cleaning up after us, you will get no incentive. This is true with housing too. We have an upside down system for wealth creation through our tax code. So we should be looking at particularly the black homeownership, I think, crisis right now, pension crisis, not as important as perhaps expanding Social Security benefits, but we should all be doing more to ask what people can do to build wealth at the bottom. So with that, I am going to go to our illustrious panel, having cheated and taken my opportunity to give the policymakers' view. We have a great panel here. We have Stefanie Stantcheva, who is professor of economics at Harvard, currently associate editor at the American Economic Review. I will not go on, as people have all the list. She will go first, and then Gabriel Zucman from the University of California, Berkeley, who has certainly been in the middle of both academically and publicly on the issue of a wealth tax, will go second. And then Wojciech Kopczuk, professor at Department of Economics at Columbia, will be our third speaker. And then hopefully we will, as we have in the past, had time for questions above, but also questions from the floor as we close out this really outstanding day. Let me say to Donnie and Olivia as we started, this has been just an extraordinary conference that has been worth sitting and listening to for 2 full days, and I'm confident our last panel will not disappoint. So thank you.
What I want to talk to you about today is that when it comes to progressivity and redistribution, we as a society and as citizens have quite complex considerations, attitudes, and views, sometimes quite stark misperceptions, and that it's very important for us as economists and researchers to go and study these things. And the tool that I want to use here and that I'm going to talk about is large-scale surveys of people. So really trying to get into people's minds, to listen more to people, and not in a idealistic or wishful way, but rather as a rigorous tool for research. So the tool we've been deploying for several years now is these large online surveys, which are typically run in several countries. Today I'll focus only on the US for the sake of this conference. And really these surveys allow us to get at things which are completely invisible in other data sets, no matter how high quality these data sets are. So before we used to use surveys to measure things which today are better seen in admin data, like incomes, transfers, etc. But perceptions, attitudes, reasonings, underlying economic behavior and outcomes are still not visible in other data sets. And so I think high quality surveys are really key. They can be large sample representative, or they can be very targeted to specific groups, which are often hard to reach otherwise. And I put there are surveys, and then there are surveys, so the quality of the design really matters. You can make them nicely interactive, animated, intuitive, to really get at the underlying perceptions. They can have some experimental component. I'll show you some studies in which people see some information, others don't, and so you can see the effect of providing that information, for instance, and they can be combined with natural experiments. For instance, using it to combine it with characteristics of where you live, where you've moved to, what programs you've received in a quasi-random way, etc. Okay. So I'm going to talk to you about 4 big issues on redistribution and progressivity. I'll go relatively fast, but which really I think can help inform a little bit the debate about what people think and want when it comes to progressivity. So the first big element is this idea of the belief in the American dream, a very salient topic in the policy debate, and that really shapes our views on redistribution. So if I want to summarize the model in literally one verbal slide, it would be this. The more social mobility you think there is, the more equal opportunity you believe there are, then the less you perceive a need for redistribution, and the more you can, tolerate unequal outcomes, the more fairly they're perceived. The problem, or the big issue, is that it's not more social mobility per se, but rather more perceived social mobility. So the reality is not always in line with the perceptions of mobility. So this thing has been established, and it's true that making people more positive about social mobility reduces support for redistribution, but the actual underlying perceptions are not necessarily accurate. So we did this study in several countries. I will show you for the US here. We elicit people's perceptions of mobility, and we do it through this ladder design. So the left ladder is the parents' income distribution, classified from the richest 100 families to the 100 poorest. And then on the right is the children's ladder when they grow up. And if you take 100 kids from the poorest families, we ask respondents to allocate them to each of the quintiles once they grow up. Okay, and from this you can see what people think about mobility. And what do we find? Well, the first thing to see is that people who are more pessimistic about mobility or more optimistic have very different views on redistribution. So on these graphs, on the x-axis, on the left graph, you have pessimism, which is the perceived probability of a kid staying stuck in the bottom quintile. So the more you move to the right, the more pessimistic the respondent is. On the y-axis, you have their desired preferred top tax rate. Okay, and you can see that people who are more pessimistic about mobility would like to have a higher top tax rate. On the right graph, it's the perceived, if you want, American dream. It's the probability of moving from the bottom to the very top. And here you can see that people who are more optimistic about this chance want a lower top tax rate. You can see the exact mirror image if you look at, instead of the top tax rate, at the bottom 50% tax rate. It's exactly the mirror image. So the more pessimistic you are about mobility, the more redistribution you want, and vice versa. But here is the perception versus reality. So on this graph, it's about this probability of staying stuck in the bottom, okay, of staying in a poor environment if you're born in a poor environment. The x-axis is the reality, how many kids out of 100 will truly remain in the bottom quintile, and the y-axis is the average perception for these 5 countries here. So you can see that in the US, people are relatively accurate on average. In Europe, people are too pessimistic in the sense that they believe many more people will remain stuck in poverty than is actually the case. What about the American dream idea, moving from rags to riches? So that's here. So now again, on the x-axis, you have the actual probability of a kid moving from the bottom to the top. And on the y-axis, you have the average perception. So here the image is very different. European countries are almost accurate, pretty accurate on average. And notice that they have a higher mobility on average than the US. The US is really overly optimistic. So this is true, by the way, if you look at people at different income levels, different education levels. It very strongly varies by political affiliation. So people towards the right of the political spectrum are much more optimistic about mobility than people to the left. But the US really has a salient idea about the American dream, which is currently not true, perhaps was true in the past, but not today. Okay. The variation in geography is very stark too. So if you look at this map about actual social mobility by state, darker colors mean more mobility, more kids, that's the number of kids out of 100 that will make it from the bottom to the top quintile. You can compare this to the map of perceptions from our surveys. This is the map of perceptions. So let me put them next to each other for clarity. And you can immediately see that perceptions are unambiguously more optimistic everywhere, but especially in the lowest mobility regions. So in fact, if you take the ratio of the perception to reality, you can see that in the southeast, perceptions are almost double the reality in terms of the chances of moving. Okay. Second big issue is who benefits from redistribution. And here I want to talk to you about this notion that generosity doesn't travel very well across national, ethnic, and religious lines. And people are much more averse to redistributing to people who are more different from them. And if they think it's going to benefit people who are not like them. And so I'm going to talk to you about redistribution in immigrants. So simply making people think about immigrants in an experimental way by inverting the order in which you ask them questions about immigrants versus questions about redistribution and progressivity makes people more averse to redistribution. And even to the point where they want to donate less private money to charity, real money out of the pocket. So clearly, there's something about wanting to not redistribute towards immigrant or, other groups different from us. But perceptions about immigrants are actually quite wrong. So to start with, for instance, if you ask people about the perceived share of immigrants in a country, let's focus on the left graph. Each row is one country. There's 6 here, US, UK, Sweden, Italy, Germany, and France. The blue is the reality. So for instance, in the US, there's 10% legal immigrants. If you add illegals, it would be around 13.5%. The red is the average perception. So people really, really starkly overestimate the share of immigrants. If you're worried about outliers, because we do worry that the distribution is skewed, the median is almost the mean. So the median respondent is very, very off. On the right, you can see how this varies by characteristics of people. And I'm not going to go into great detail, but left and right-wing respondents are very similar in their overestimation of immigrant share. However, they have a very different perceived composition of those immigrants. So let's look at that. So one stark feature as well is the perceived share of Muslim immigrants among 100 immigrants. And here again, the blue on the left shows you the reality per country, and the red is the perceived average share of Muslim immigrants. And you can see that in all countries, people really overestimate the share of Muslim immigrants. And here, if you focus on the right graph, very bottom, you can see that right-wing respondents much more overestimate the share of Muslim immigrants than do left-wing respondents. When it comes to poverty, you can plot the perceived share of the poor, defined as living below the poverty line, but it works for other cutoffs too, the perceived share of the poor that people think are immigrants. And so who's going to benefit from redistribution? You can see that people really starkly overestimate the share of the poor that are immigrants relative to reality. And finally, if you want to test directly whether people are more biased against immigrants, you can ask, consider John and Mohammed. They both, make the same income, live in the same state, have the same family situation. Does Mohammed pay more taxes, less taxes, equal taxes than John? And same for transfers. Does he get more transfers, same transfers, less transfers than John? And this is the share of respondents per country that say definitely Mohammed pays less taxes than John and gets more transfers. Okay, so this is clearly not true given the information we give purely in the survey, and so it does reflect a bias. And here you can also see a very stark gap between left-wing and right-wing respondents in that answer. Okay, what about if we provide news about inequality and how things actually look like in the US? Does that change people's demand for redistribution? The answer is no, but it does reduce trust in government and actually makes people really skeptical about the government's benevolence or ability to do things. So what we did in this survey was to tell people, enter your annual household income in the box, and then a slider basically shows you where you are in the income distribution based on that. Then you can actually move around the slider and explore the whole income distribution, see how many households make less than a given amount. We can also look at this dynamically over time. Based on the income you entered, we can tell people if growth had been equally spread since the 80s, where would you be today? And in fact, if you do this, most people except the top realize that they would have been better off. And so for most people, it's negative news here. And what we see is that this does not change demand for redistribution, or barely. However, it makes people think that the government cannot be trusted, that the government is not doing things right. So this was a bit of a negative message that pessimistic news about inequality is not pushing for more redistribution, but rather, reduces trust in the government. And I'll end on a completely new study which I've been running, which is about the misunderstandings and views on tax policy. In fact, it's also about health insurance and trade. Results I won't show you today. It's about trying to understand how we reason about economic policies when we don't put on our economist hat, but rather our citizen's hat. And just a few things that I would like to point out. So everyone thinks that the top tax bracket kicks in at much lower income levels. So most people think the top income bracket starts at around 200,000, which is far off from reality. If you ask people, were the tax rates in the 50s higher, lower, how high were they? Most people have really no idea that the tax rates were much, much higher, top tax rates in the 50s. When you ask about who's at the top, who are the rich people, who are the high income earners, there's a stark overestimation of people who are, entrepreneurs. That's quite stark. Of people who are scientists, I wish, entertainers, very stark, media, sports, and really an underestimation of people who are managers and executives. So there's also a different skewed perception of who's really at the top, and that possibly shapes our views on progressivity. So another thing you can do is to very quickly ask people, instead of priming them about one question or the other, just say, what should be the goal of a good income tax system? Right. And so people write in open-ended text boxes. And then you can do text analysis on these responses. And I find them very informative because without priming anything, you see what responses come out. And for instance, what should be the goal of a good income tax system? You can already see the topics jumping out at you. And you can do more. You can take these words and actually classify them through an algorithm called topic analysis, which is going to group together terms that constantly appear together. And you can assign topics to those groups of terms. So I've assigned them some names based on what the algorithm spit out as groups, and you can look at these topics as they appear by political group, for instance. So one is an equity topic, basically considerations of fairness. One is an efficiency topic, considerations of, distortions caused by the tax system. The other is the government's budget, particularly the debt. The other is wealth concentration. And the final one that appears organically, if you want, from that algorithm is loopholes. And you can plot the topics representation ranging from Clinton liberals, that's the dark blue, all the way to Trump conservatives, that's the red. And you can very clearly see debt considerations, government budget considerations are much more rising to the right, wealth concentrations are much more rising to the left, loopholes are also slightly more prevalent on the left, efficiency is slightly more prevalent to the right. And I'll just end with the estate tax, which is the closest we have to the wealth tax. So it's very unpopular and it's very misunderstood. So most people think that many more households pay the estate tax or will pay the estate tax than is actually the case. The reality is less than 1 in 1,000 households, but people think it's 364 on average out of 1,000. So the exemption threshold, clearly the reforms have not caught up in the popular mind because it's believed to be 4.6 million, which is much lower than it is now. And just informing people about who actually pays the estate tax, namely how high the threshold is and how few estates are above that threshold, already increases support for it quite dramatically. And so let's just ask, what are the main shortcomings that people think about when they think about the wealth tax? It's very clear what the main shortcomings is. That's double taxation. Without priming in any way, that's the word that appears most often in big here on the screen when people are asked to think about the shortcomings of the estate tax. And I'll just end with this topic analysis of the wealth tax. It's again pretty skewed politically. So wealth concentration is the main consideration that comes up for people on the left. And double taxation is the main consideration that comes together with government debt and budget when you talk about to people on the right. So I think there's a lot to be learned from such surveys. There's plenty more information in the paper that I cannot show here, but I think it's critical to really get into our minds as citizens, into people's minds, and try to see what those reasoning, perceptions, and attitudes are. Thank you.
So I'd like to talk about whether wealth tax can work. There is a demand for progressive wealth taxation. So you look at opinion polls, for instance, and what you see is that 60–70% of the electorate in the US, according to these opinion polls, is in favor of a tax such as the tax that was proposed by Senator Elizabeth Warren, tax of 2% above $50 million, 3% above $1 billion. That's even before taking into account explaining how the revenue would be used. That's just polling on the tax itself. Is it a good idea? But of course, the revenue matters a lot. I think it's extremely important to the number one argument for why we might want a wealth tax in the US is wealth is concentrated. There's a lot of wealth at the top, can generate a lot of revenue to fund education, healthcare, and so on. A lot of the debate has been, so let's assume that this becomes reality. Let's assume that, I'm not holding my breath, but a wealth tax passes Congress in 2021, and that's the law of the land. Question is, will it work? And more importantly, how can we make it work? How can we contribute? And what can we learn from the international experience on that question? So these are questions that we discuss in our book, Triumph of Injustice, which Manuel says, And the points we make in chapter 6, 7 is, look, tax avoidance, tax evasion, tax competition, these are not laws of nature, just like Gene said. These are policy choices. So sometimes governments choose to let taxes fail, but they can also choose to make taxes work. And with good fiscal plumbing, I think the United States would be in a good position to make a wealth tax work. So let me illustrate this. So what's the European experience with wealth taxation? Let me be very clear with the fact that this experience was a failure. Okay, it is a big intellectual and political failure. And that's due to three reasons: tax competition, tax evasion, and the way these taxes were designed. So let me start with tax competition. Europe has and still embraces tax competition. France used to have a wealth tax, and a French person who wanted to avoid the wealth tax could simply move to London, could simply move to Brussels. That's a 90-minute train ride from Paris. Immediately, right after moving, that person would not have to pay taxes anymore in France. That's a choice that was made. France could have said, look, you've made a huge fortune thanks to French markets, French infrastructure, French schools. And now you want to leave the country to stop paying taxes. We're going to continue taxing you for, 5, 10 years. What the US does is the polar opposite, is that you leave the US, you have to continue paying taxes in the US forever, because taxation is based on citizenship, not on residency. That's not how taxes work in Europe. Second problem is tax evasion. Until very recently, there was no exchange of bank information between banks in Switzerland, in Luxembourg, in tax havens at the very heart of the European Union, and other EU countries' tax authorities. So you open a bank account in Switzerland, you have a bank account in Luxembourg, and if you don't self-report your wealth on your wealth tax return, there you go. You can evade taxes extremely easily. Third is the way that these taxes used to work, and in some countries still work. These wealth taxes started very low in the wealth distribution, typically around $1 million in net wealth, which over time generated lobbying from taxpayers who said, look, I just have a house or a small business. I'm not liquid enough to pay for the wealth tax, so you should exempt main homes, you should exempt small businesses, you should put a cap to how much the wealth tax can be as a fraction of taxable income, which led to base erosion. Okay? The US context today is very different. The US is in a much better position today to make a wealth tax work. First of all, the US taxes expatriates. You're a US citizen, you move abroad, you have to continue paying taxes in the US with credits to offset foreign taxes paid. But if foreign countries don't have wealth taxes, you would have to pay the US wealth tax. The only way to avoid the a potential US wealth tax would be by renouncing US citizenship, which is a very extreme move. And in both the Warren and the Sanders wealth tax plans, there is a stiff exit tax for citizenship renunciation. The idea being always the same. You've built $100 billion fortune thanks to US markets. In particular, and US infrastructure. Now you want to leave the country, in the Warren wealth tax, you have to pay 40%, 40 billion in exit tax. Second, the US receives information from foreign banks. That's a major achievement, tax policy change during the Obama administration, the Foreign Tax Compliance Act, the Foreign Account Tax Compliance Act, FATCA, that was passed in 2010. This is a law that mandates foreign financial institutions to automatically report to the IRS about the holdings of US citizens under the threat of stiff economic sanctions. And under this threat, virtually all tax havens and foreign financial institutions have agreed to cooperate. I'm not saying it's working perfectly, in particular because IRS budgets have declined so much that these FATCA reports are not used in a systematic manner, but with more budget for the IRS, these FATCA reports could be matched automatically to income and wealth tax returns, making it very hard for wealthy people to hide assets abroad. And the last difference is the very high exemption thresholds in the current wealth tax proposals: $50 million in the Warren wealth tax, $30 million in the $32 million in the Sanders wealth tax. It's obvious for everybody that someone who has more than $50 million, let's say someone who has $100 million, will always be able to pay $1 million tax, which would be the tax bill for that person under a Warren tax. And so it makes these taxes much less vulnerable to the type of lobbying that eventually undermined the tax base in Europe. Now, to make the tax work in the US, there are a number of important points that will need to be taken into account. It's very important, that's another lesson from the European experience, to tax all assets at their market values. Now you're going to tell me some assets don't have market values, and my answer is going to be create a market. That's how you create market values. So concretely, you own shares in a big unlisted company. The IRS could use valuation methods that exist in the private sector to put a value on these shares, on these assets. And if the taxpayers are unhappy with the IRS valuation, they would have the option to pay in kind with shares of the company. And then the point is not for the government to own shares in private businesses. The point is for the government to sell the shares on a market, and in effect to create the market that currently is missing. So create market values. Last is, there is tax avoidance. Regulating the tax avoidance industry is a choice. Okay, and much more could be done. You could create a public protection bureau, for instance. That's a proposal we make in the book that would make sure that any new tax dodging product is automatically reported to that agency, and any tax avoidance scheme that violates the economic substance doctrine is automatically outlawed. And the big picture idea that underpins all of that is an idea that actually is in work by Wojciech and Joel Slemrod in a very good 2001 paper. It's the idea that, look, too often public economists tend to think as elasticities as immutable parameters. But that's wrong. These are policy choices. You can reduce elasticities with proper enforcement, with good tax design. All right. Is it worth all the trouble? Look, there are many ways to collect more revenue from the very wealthy. There are many ways, but the wealth tax is the most direct and powerful way to tax the very, very rich. And when I say that, I don't want to say that we shouldn't close loopholes, we shouldn't have a more progressive income tax, we shouldn't fix the corporate tax. We should do all of these things. But these things would not be enough to make billionaires, to significantly increase the effective tax rate on billionaires. Why is that the case? You take the case of Warren Buffett. According to Forbes magazine, he's worth $80 billion. His true economic income is something like 6% of his wealth, around $5 billion. His taxable income, what he reports on his tax return, we know that because he makes that public, is of the order of $10 to $20 million. What's the reason for this? He's the main shareholder of Berkshire Hathaway. He instructs Berkshire Hathaway not to pay dividends, 0 dividend payments. And then his only taxable income is when he sells a few shares each year, and he pays a little bit of capital gains taxes on that. So if he realizes $10 million in capital gains in a given year, the capital gains tax rate is 20%, he pays $2 million, his effective tax rate out of his true economic income is 2 million divided by 5 billion. This is 0%. You can increase the top marginal income tax rate to 99.9%. It will still be 0%. Okay, that's very important to understand. So I'm not saying again that we should not, it would not be a good idea to increase the progressivity of the income tax. It would, but it would not address problems such as the one I just described. Corporate income tax can address some of that problem because corporate profits, that's income that's taxed, whether it's distributed as dividends or not. But it's a too crude an instrument because it's a flat tax rate, 21%. Today could increase to 50%. Would still be a flat tax rate. And if you want some progressivity, taxes based on ability to pay, you want a progressive system. So this is just an illustration of how the war and wealth tax, for instance, would change tax progressivity at the top end. So today, when you distribute 100% of tax revenue in the US across the population, taking into account all taxes at all levels of government, you get a very mildly progressive tax system that becomes regressive at the very top, with the top 400 richest Americans paying about 23% of their income in taxes for the reason that I mentioned. With the one wealth tax, you double that to 46%. And let me just finish with this. I'm very struck by the following fact, which is the similarity in many ways between the debate we're having these days and the debate during the Gilded Age and before 1913. Before 1913, you have a rising inequality. You have a very unfair tax system. The only federal tax is the tariff, highly regressive. That's the context in which there's a growing demand for progressive income taxation. And then you read, many contemporaries, including distinguished economists, before 1913, and what do they say? Progressive income taxation, it will never work. It's impossible. How are you going to measure income? It's a European idea, imported by European professors. Seligman, who was professor at Columbia University, was one of the main proponents of progressive income taxation. On the right, you had things like, it's going to invade privacy, it's confiscatory, it's going to harm growth and job creation. But many very serious people genuinely believed that it would never work. And of course, it was unconstitutional. And the Constitution changed in 1913, and the top marginal income tax rate increased to above 90% in the middle of the 20th century. And I think that everybody today agrees that the federal income tax is a huge success. So what I'm saying is the history of taxation is full of U-turns, and if governments want to make taxes work, if there's a demand for redistribution and more progressive taxation in the population, that's something that can be done. Thank you very much.
Even though I'm not going to talk about the wealth tax, I can still criticize some things. So probably 1/3 of my presentation will be comments on things that were shown before today, and then I will talk about where I see the sort of where progressivity should be, or the discussion of redistribution should be going, in my view. All right, so. People talk a lot about facts about inequality, and graphs were showing up here. I'm not going to sort of go into a lot of details about any of this, but I would like to just stress that this is an active research area. So when you're just seeing one graph that shows the evolution of wealth or income inequality, you should realize that they are contentious, and they are contentious for a good reason. They are contentious because these things are very difficult to measure. You don't know a lot of the information that's behind these things, and you have to make assumptions. So this is a graph that Emmanuel showed yesterday on wealth inequality. It sort of shows the different methods sort of seem to line up. This is a graph from a new paper by Smith, Zidar, and Zwick that revisits their capitalization methodology, that makes a little bit different choices about the unit of observation. And you see a much wider range of the estimates. One of those, the estate tax, I'm completely on board that it should be revised upwards. This is from my paper that with Emmanuel now 15 years ago, where we made one strong assumption that that mortality differentials between poor general public and the rich were constant, and there is now good new evidence that they've been increasing. So that's a revision. But these are papers that are sort of manipulating or changing assumptions that are really hard to know. Like, what is the rate of return on the types of assets that rich people hold? Is it the same as the rate of return for everyone else? Like, we have some evidence, we have some guesses, but it's hard to know. This is a comparison of income inequality numbers from Piketty, Sayers, and Zucman, and Totten and Splinter that again shows very different patterns. Now, why do they show different patterns? This is sort of a long list of things that once you start reading through this, you realize that these are things that we don't really know very well. These are things like, if you take national accounts, there is tax evasion, it needs to be allocated to somebody, to the bottom or to the top of the distribution. We don't know exactly where. We have to rely on some evidence to do that. There is a lot of money sitting in retirement accounts. They are not linked to individual tax returns, or at least that's not how we are observing them. We have to allocate them. We have to make some decisions on these. So all of these things, you can make guesses, but there are different sets of researchers that make different guesses or sort of use the best information that they can think of. And what I'm struck with all of this, especially when it's presented as a fact, is that that's not how we do things elsewhere. We estimate things, we put standard errors on those things, we talk about confidence intervals, we talk about error bands, model uncertainty, things like this. None of this is done in this particular context. I think it should be done. When you see a number or a series that's based on a huge set of assumptions, and you can tweak those assumptions and the tweaks, I'm not subscribing to any, we could talk about details of this. Like, there are things I dislike about one paper, there are things I dislike about the other paper. But when that gap is of the order of 6 percentage points, that tells you that there is a lot of room for subjectivity and for error, and even if you try to do your best. The same applies to various measures of progressivity. So Gabriel showed one picture about progressivity. This is a comparison of the evolution of the top 0.01% tax rate according to two of their papers. One is a QJE paper from a year ago. Another one is what's in the book. The evolution of these two things is different, and it's quite dramatically different. Maybe that doesn't strike you on this graph, but these are one of these measures drops by 18 percentage points, the other one drops by 4 percentage points, and that's sort of playing with assumptions. There's no underlying, no major updates of the data. So there are definitely sort of, don't think about these things as facts. There is definitely a lot of evidence that something has been happening. So in particular, if you go back to these graphs, both of them show increasing inequality. Everything here shows an increase in inequality. So I don't think the debate is about whether there was an increase in inequality. And I think there is a much less, even less debate when you start to thinking about things like wage stagnation and what's been happening at the bottom of the distribution. There are contentious issues there as well, but those things are not necessarily, we know more or less what's been happening, but the errors that you can make at the very top of the distribution are large because there are a lot of things that we don't know. So I start with that. And there are a lot of other problems that I'll signal to. So one is once you start thinking about international comparisons, this is from my paper with Anne Talstadseter and Kjetil Tolle and Martin Jacob in Norway. If you look at the income tax returns, this is, let's take the red line, one of the red lines. This is sort of what you would get as income inequality in Norway, this is top 1% share, evolution over time, relying on the income tax return data. What is it that you're missing? What you're missing is money that sits in closely held businesses, not publicly traded businesses, small firms. We can see through the firms. Once you add that, that's the picture of the inequality. The big bump in the middle, or the big break point in the middle, is a reform that changed the incentives. That basically encourage firms to retain a lot of earnings. So once you have things like this, you have to start thinking seriously. When I compare countries with different regimes, countries with different levels of tax rates, how do I think about these comparisons? This literature yet awaits the sort of serious considerations of that type. You can impute things. This is the blue line is the imputation that we've done there. That sort of follows kind of the types of imputations that were done elsewhere. It gets you some way there to the black line, but it doesn't get you all the way there. So you are going to make errors. All right. So that's my criticism part. Let's get back to the topic of progressivity. So I take the discussion and I subscribe to the discussion over the last 2 days, and I subscribe to most of to many of the things, not everything that was said. There are a lot of worthwhile spending priorities. I would think about spending on children. Something will have to be probably done with healthcare. There's social security crisis. There is Medicare. There are a lot of other things that you can think about, and you need to raise money. Right, how do you raise money? One way to think about how to raise money is to think about taxes that don't exist. The other one is to look at what other countries that raise more money do. Right, so that's the comparison of the United States, Canada, and OECD average. Right? US collects less revenue. Other countries collect more revenue. Where is the big difference? I highlighted one thing that's important because that's a tax that the US doesn't have, and that takes you almost there in terms of explaining the difference in the amount of revenue that's collected, and that's a value-added tax. So on average, in OECD countries, it collects 7%. In Denmark, it collects 9.4%. In New Zealand, it collects 9.4%. These are percentages of GDP. So these are taxes that can collect and do collect a lot of revenue and go a long way toward explaining the difference. So knowing that, my first instinct is, if the US is going to raise a lot more revenue to pay for things, like what should we be thinking about? Well, that's a place where we should be thinking about. That's where the really serious money is located. Okay, you can go through other components. So here is a comparison. Red and black boxes are individual income and corporate taxation. US collects a bit less than other countries in corporate taxes. Slightly misleading because the US has a very large, unusually large share of pass-through businesses. So it taxes a lot of businesses through individual income tax returns. But sort of looking at this, maybe, let's compare it to Canada, for example. Maybe there is room for more progressivity, and especially after 2017, there may be room for more progressivity. So I'll talk a little bit about that as well. Where else do other countries collect revenue? Very regressive payroll social security taxes. That's another big chunk of revenue. This is wealth and estate and gift and inheritance taxes. Like you have to squint. There are blue and red things somewhere at the bottom of these graphs. They are almost not there. As a source of revenue, it doesn't exist. Now, that doesn't mean that they may not be important for progressivity. They may be very important for progressivity. I actually think the estate tax is hugely important for progressivity, but they are not big sources of revenue anywhere. All right, so what would I do? So other countries finance their spending through taxes that are, they have income taxation, they have corporate taxation, but the bulk of revenue comes from regressive taxes. Now, why do we think about them as progressive? Because they spend revenue progressively. So that's the big difference. So if you want to be like Denmark, or you want to be like European countries in terms of sort of overall taxation and spending patterns, which I think is not a bad idea to kind of look to them as examples, because these are countries that implemented that model definitely better than the US. That's what you have to think about. Now, so what would I do on in terms of like what policies would I suggest for the U.S.? So one, okay, so I'm not advising any campaign, which I think still entitles me to make proposals that are not completely realistic. So VAT would be on the top of my list. I don't know if it's going to happen. It's not going to happen tomorrow. It's not going to happen next year, but we should be talking about VAT. There will be a time when we will need VAT. There are simpler things and kind of immediate things that could be done, and a lot of them are on the income tax side. The most obvious, and I'm repeating some things that were said today, are related to capital gains taxation. So number one, the most absurd piece of US policy that there's actually a paper by a lawyer that documents how it came about by accident a long time ago, 100 years ago, when the US started taxing capital gains, is the step up between basis and death. You die with capital gains, that's forgiven. That makes absolutely no sense. There is no economic rationale that I can think of that would have that type of a policy. So that should go. Like that's immediate. Like there is no reason why you wouldn't touch that. You can do much more on capital gains. Effectively, if you are on board with things that they suggest as ways of improving wealth tax, they also help with taxing capital gains. Because if you can tax wealth and you can measure value of underlying assets, then you can measure capital gains or capital income in general. So I take, there are intriguing parts of those proposals in terms of administration, and we should think about them seriously. They don't necessarily take you to the wealth tax. They can take you in the direction of improving how capital gains taxation works. I'm open to, and I actually think it would be a good idea to considering various ways of marking to market for publicly traded assets. There are things like retrospective capital gains taxation due to Alan Auerbach that doesn't require valuing assets every year. It sort of taxes things when they are sold on realization and sort of tries to account for the path. Removing carried interest, that's obviously, that's a good idea, not with a lot of money in it when you look into it, but it sort of doesn't really have a lot of justification. When you start thinking about what's important at the top of the distribution, again, sort of thinking about a different paper by Smith, Zidar, Yagan, and Zwick, pass-through businesses. We've just had a big pass-through loophole tax reduction introduced. Like that's I'm assuming next tax reform will remove that, but there is more on the pass-through side that should be done. There are ways to avoid payroll taxes by appropriately organizing and so on. So we can basically disguising wage income as capital income. There are various other loopholes of that type. Then there is the estate tax, and while I'm critical of the wealth tax, I actually tend to like estate tax, and the reason is that estate tax is imposed once. It's imposed when things have to be valued anyway. It has a double taxation feature because it's a tax on the capital, and presumably parts of these things were taxed before, but that's once every 40 years. No, 30 years, let's say, or depends, okay, doesn't matter how many years. You have to start thinking about distance between parents and children and whether it's self-made or not, and so on. So it's taxed rarely. So double taxation doesn't bother me as much. But most importantly, it has this clear connection to the equality of opportunities. And that's, I think that to me, that's the biggest aspect of things. And it also, if you are worried about ambiguous concerns about wealth concentration, then it's sort of going after those as well. So the last thing that I want to mention, and that's sort of not purely tax related, but I think didn't get as much attention here, but I think it's hugely important. So what are the types of things that I think about when I think about political power, money that's not being taxed, influence, and things like this? A lot of these things tied to charity and nonprofit sector and various things like this. So I think we are very much overdue for rethinking how that side of the economy works in the United States. That includes things on the tax side. It includes how we are providing. Should we be providing breaks to charity? If we are, why are we providing them in a way that relates to the individual income tax rate? If the benefit of charity goes to other people, then it's presumably roughly constant. Doesn't matter who gives the money, so it should be tax credit rather than a deduction. But we probably can go beyond that. Like, what are legitimate charities? What are legitimate causes? What are less legitimate causes? How much do we allow different institutions to accumulate in terms of assets? Like, why do we have a big untaxed pools of wealth lying around in various places? That shows up in sort of in many different ways, through tax avoidance in the estate tax, through political spending. It shows up in the carried interest that's partly play on the arbitrage between non-taxable and taxable investors and so on. So this is sort of to me, that's one great opportunity for rethinking what's often ignored but a very, very important, I believe, feature of the U.S. system that sort of ties to a lot of topics that we discussed.
Stefanie, I think Olivier was saying to me, and I think probably other people were wondering too, not based on your own personal preferences, but on your own research, if the new president said, just as a social scientist, if you wanted to successfully communicate to the American public how you were going to make taxes most progressive in a way that reflected your research, what advice would you give them? Would you have a specific measure or type of measure that you would recommend, not your preferences, but just what your research dictates?
Yeah, that's an excellent question, and I've grappled with it. In fact, part of the project that I showed you was not just to describe what people know, what people think, but also to try and see whether explanations can actually help. And what I did was to design, I would call them mini econ courses, which it's infographics with videos and sound that explain how the tax system actually works. One version focuses on the redistributive aspects of it. One version focuses on the efficiency aspects of it. And the third, which I call the economist version, focuses on the trade-off between these two. And what I find is that actually just explaining things without priming one way or the other. So it's not about pushing one aspect over the other or giving, elasticities or actual optimal tax numbers really makes people more favorable to, to redistribution, understanding what the implications are. So I think one thing that I would recommend is to have educational, educational outreaches that actually help understanding without trying to push people one way or the other. It's not about, oh, we need to achieve more progressivity, how to convince people of that. Not at all. It's just about, I think, giving people the tools as citizens to actually judge policies better in an informed way.
Gabriel, I know we see you deal with your critics, and there's and I probably somewhat took the liberty as your moderator of showing my agreement with you, partly because there's not much of a chance that we're in much of a majority here. But what I want to raise with you is what not the kind of ultimate critics, but what a lot of people sympathetic say to me and probably say to you, which is, it is good you are raising the issue of wealth concentration and wealth inequality, and it is good to tax more. But why do I create a brand new system that brings all these complexities when you could get rid of stepped-up basis and do mark-to-market capital gains, do an increase high state tax, and as Vice President Biden's recommended, and a couple of other candidates, simply level out the ordinary income and capital gains dividends, at least for the top 1%. Why not do that? And what would be the disadvantage? And would those be compared to the wealth tax for you, a 5 out of 10, a 4 out of 10, an 8 out of 10?
I think both are important. Fixing the step-up basis at death, more progressive income taxation, fixing the corporate tax, better taxing multinational companies, curbing profit shifting to tax havens, fixing the problems with pass-through businesses. I subscribe to all of this, to everything that Wojciech said. Now, if you run the numbers, and we developed a website, taxjusticenow.org, where you can run the numbers. You do these tax changes, and the website shows how much revenue this generates and how it changes tax progressivity, that is, how it changes effective tax rates across the distribution. And you can collect a sizable amount of tax revenue by doing all the things I've just mentioned, but you are not collecting as much revenue as you could do, in particular because of the problem that I mentioned of how to tax the income of billionaires like Warren Buffett. None of these proposals addresses that. And you might say, look, with the estate tax, eventually very wealthy people will pay, if we close the step-up basis loophole, except that, look, is it wise to wait for 50 years for Mark Zuckerberg to start paying taxes? Is it really a wise thing to do? Why not start now? Why not try to, make him pay more taxes today? Many of the billionaires Emmanuel showed yesterday, the very top of the Forbes 400 list. Some of them, many of them are relatively young and still have 30, 40 years to live. So the estate tax is not enough, and the wealth tax, given how much wealth there is, and of course, there are various estimates, and it's perfectly legitimate to have a debate about that, and there is some uncertainty on the scoring, but everybody agrees that there is quite a lot of wealth concentration in the US. There's a lot of tax revenue, and it increases tax progressivity more strongly, more powerfully than other measures.
You made the case for the estate tax. Let me press you on that. I've obviously spent a decent amount of my life on that issue, and not always successfully, as you can see. But you've had a system in place. It is stunning, the industry that has gone up in telling people how over a 20, 30-year period to slowly give money to your children, et cetera. There's a Federal Reserve paper that says 55% of wealth in estates over 100 million are never taxed wealth. So I guess my question is, and that I want to ask you, is your view or what would you say to the view of that actually from an avoidance perspective, giving people that long to plan and to devise is going to always lead to more evasion than a year by year? And yes, it's tough to do valuations, but every city and state does it in the property tax every year, year by year. So is there any merit to this idea that perhaps we've tried the at death notion and that year by year might have any benefits for preventing avoidance?
So in general, I probably would agree that there may be a benefit to doing things year by year. That doesn't mean that there aren't ways to improve the estate tax, and kind of pretty obvious, or actually ways that I've mentioned already, that would make tax avoidance much easier. So much harder. Charity is one of the avenues that people use in the context of tax avoidance of the estate tax. So that's that was there for the reason. I've worked a lot on the estate tax. A lot of my research was on the estate tax, and that made me appreciate these types of issues. So that's one. Giving. I mean, you tax gifts. You can change how you tax gifts. If you really wanted to go after these things, you could tax them at a higher rate. You could compound it in a better way than actually it's not compounded right now. So it really makes sense to make these gifts early. By the way, gifts also work with the wealth tax. You make gifts and you remove things from your own base and you give it to children. That basically, that's something that could raise, with one child, you can double. It corresponds effectively to doubling the exemption. You can split your wealth base, and the big, one of the big problems in valuing assets in the estate is valuation, and the notion that. You cannot do it very well in the context of a tax that's paid once in your lifetime, and you are going to be able to do it every year, effectively for 100 times as many taxpayers year after year. I just don't see how that works, knowing how big these valuation problems are. And in the news a few days ago, we had WeWork, and the private valuation of this thing made no sense. These are the types of problems that you have to deal with.
I'm going to ask one question to three of you, for whoever wants to answer, and then I will go to the audience. But I think if I were doing a critique, if I was asked to do a single critique of the tax discussion that we've had, not just us, but just throughout the session, is that there's been a significant focus on the marginal tax rate as opposed to the effective tax rate. So we talk about the corporate tax rate, and yet the thing that's often outrageous to people is the effective tax rate that people have. When you look even at the top 1%, you have, there are doctors and people who are in the top 1% who are definitely paying marginal tax rates of 50% in New York, California, and other states. And yet, you have the top 400 perhaps paying half that or even lower that. Should we be having this conversation a little bit more, perhaps as we tried to do in the Obama administration, the Buffett tax? What do you actually pay? And so just any comment you have as to whether we should be focusing more on effective tax rates, even in our public conversation, and how would we do that?
What I think would be great, what we do in the book and on the website is precisely we try to estimate effective average tax rates by income groups. And, we did our best given the data that exists, the methods that we developed. But clearly, we could have more data, we could have better methods in the future. And I think ultimately, this is the type of statistics that we want government agencies to publish. And of course, there is some of that already today, but not for all taxes at all levels of government. And so more broadly speaking, I think everything that we are trying to do is create distributional national accounts, distribute total national income, total taxes, total government transfers. And the hope is that this prototype project will be taken over by government agencies, and that eventually these types of statistics going all the way to the top 400 will be published by official government statisticians. And why do we care about the top 400? Look, you have a number of tax proposals out there. Look at the Sanders wealth tax or even the Warren wealth tax that specifically target the top 400. So it's extremely important to know how much they pay today. And we have some rough estimates, but it would be much better if this was part of the official toolkit of government statistics.
I agree that we should definitely try to look at more and better measure of taxes. And the other thing which I think could really improve the debate is to make a distinction between efficiency arguments and equity or fairness arguments. They're constantly mixed, and it makes it hard to actually discuss things properly, because what are efficiency arguments? It's about what would be the economic effects of a tax. What are their economic costs? How much will people evade it, stop working, move abroad, create less businesses, etc. These things, in principle, we could agree on, especially with better and better data. There will still be disagreement, of course, because not all methods are the same. We don't have perfect data, but it's kind of a statistical, empirical question. And then there's the equity arguments, which are, social judgments, which are really up to anyone, and we have to aggregate them as a society. But it's hard to, mix those two together, because it's hard to make progress when one person brings in an equity argument without saying it's an equity argument. And sometimes efficiency arguments are also disguised as equity arguments. So I think separating those two would be a major improvement, I think, in the debate.
We care both about average and marginal tax rates. For revenue, progressivity measurement, we care about average. For thinking about incentives, we care about marginal tax rates. Behavioral responses are not zero, so we have to think about marginal incentives.
Do we have any questions, or have you been worn out or feel like there's literally nothing you can do to compete with the evening panel when my colleague Larry was here?
Ted Truman from the Peterson Institute. So I was interested, so Stefanie just came close to my question, right? Seems to me, this is a panel on progressivity, which is in some sense argues to the equity point. I mean, that's right. So I'd like to hear the other two panelists about this question. So you can think about just making things look fairer, right? Which is basically progressivity is a fairness perception question. And then there's the efficiency question, whether some of these things actually have several senses of efficiency, or whether these things are bad economic policy in terms of their substantive and the substantive impact of the tax changes that you favor. And there must be some tension between those, certainly in a political economy sense, there's some tension between them. So if you had to choose between being perceived to be fairer in the system and to perceived to be more efficient in the system, and you can't choose both, which would is unfair. That's like the kid who wants two desserts. I'd be interested in your reactions.
It's a trade-off.
We are short on time, so if you don't feel like you have to answer, if just one of you wants to answer, that's fine.
There is a trade-off between efficiency and equity, and there is probably a trade-off between perceived efficiency and perceived equity.
Thanks. Tim Scanlon from Harvard. I had two questions, one I think for Gabriel and one for Wojciech. Gabriel, one of the things I found frustrating about the exciting discussion yesterday, was I felt that it was unclear exactly what the objectives of the wealth tax were. Sometimes it seemed it was a convenient or fair way to raise revenue. Other times, reducing wealth in holdings seemed like an end in itself for some reason or other. And so I wondered if I'm sure it might be a combination of these things, but I'd be grateful if you could quickly articulate how you see that. That would be helpful for thinking about the force of the objections. And thinking about Warren Buffett, a combination of high tax on actual income, so he couldn't pass it on to his heirs without actually realizing the benefits from Berkshire Hathaway. So in order to give it away, he'd have to pay taxes on it first. So if you have high enough income taxes and then a high estate tax at the end, maybe, I don't know whether you prefer having it taxed as income to the recipient or taxed on the estate itself. But anyway, I wondered what you thought of that combined strategy. Thanks.
And I can answer quickly on revenue versus inequality. The wealth taxes have an effect on both. They can generate a lot of revenue. They can have a big effect on long-term wealth concentration. And obviously, there's a trade-off. The higher the rate, the more revenue in the short run, but eventually, the base shrinks, and so you have a reduction in wealth concentration. And frankly, I don't think that it's for economists to say, what's optimal in that trade-off. I think it's for the people to decide. But where we can be useful is by clarifying the trade-off, by showing, look, with wealth tax, with such a rate schedule, here's how much you're going to generate. And then at some point, you shrink, the base shrinks, but you reduce wealth concentration. And we see in Stefanie's data, I was very struck by the fact that, the number one concern was wealth concentration, actually. And so if people care about wealth concentration, and they want very high wealth tax rates on billionaires for that reason, look, that's a democratic choice.
Short question to Gabriel. You say when markets don't exist, then create them, which means basically give the shares to the state or something like this. Well, that has other implications than just giving the shares. It basically makes for a public company rather than a private company. That's non-trivial. Yes. That's what you want.
Yeah, that's not a trivial thing. That's a new idea, and I think there needs to be a lot of hard thinking about how to implement it in practice. But think, for instance, about Bloomberg. It's a big private business. If there was a wealth tax, he would have to pay a lot. What I'm saying is the IRS can come up with a valuation, and if the taxpayer disagrees, prefers to pay in shares, yes, and then the government auctions the shares, and then you need to think about what are the requirements in terms of what should be disclosed to the potential investors and so on. These are important practical questions, but conceptually, the idea that we can create more markets, and that's a good thing in of itself. We economists, we like markets, we like market values. I think it's a sound idea.
I'm very intrigued by that idea. I said it before. I don't see how it could be realistically implemented.
I think in the Warren tax proposal, they don't go there. I believe they offer people a period of a number of years in a startup to do evaluation. So, but I think this is clearly this issue of the valuing, even for an advocate of the private held and the year by year, is certainly going to be I think the most difficult issue, and it's worth recognizing that. But there doesn't seem to be just one idea out there.
I think this is a hint of why European taxes failed. That's basically what was happening. Once you start valuing these businesses and you have to value them every year, and you realize that it doesn't really work well in practice, you start providing breaks, loopholes, special regimes, preferences. You don't tax some of them, and then it goes downhill.
Can I quickly answer?
The key problem is that it's not a tax based on transactions. It's not arm's length transaction tax. Anytime you have taxes like this, they don't work well.
Yeah, no, just to put that discussion in perspective, the top 0.1%, in terms of the composition of their wealth, about 70% of their wealth is in listed securities, listed equities and bonds and mutual fund shares. So that's what you see, in the SCF data. In our data, it's even more than that. But let's be conservative. And for some businesses, it can be hard to come up with a valuation. But look, there's a huge financial industry in the US that does what they do is to value private businesses. That's their job. They create. They manage IPOs. They do transactions of private businesses. we can draw on that industry. For instance, anytime that there's a valuation that's created by that financial industry, it could be required by law to send information to the IRS. Let's say a private business is valued by, I don't know, Goldman Sachs. Then Goldman Sachs would send information to the IRS. The IRS would use that as the basis for their valuation of the private business.
I'll repeat this argument again. We've just seen a spectacular failure of private valuations. So WeWork was an example of spectacular failure. Like relying on that process for tax valuations is not really a realistic idea.
Okay, so for those of you who think I would have failed as a moderator if I didn't get them going back a little, as if it was Twitter, I want you to know that I did get some of that exchange. Thank you very much. Thank you to our three panelists.